So Terry, you've announced some changes to the structure of the Smithson Investment Trust, moving to an open-ended fund. What's the driver for this decision? This is quite a significant shift to a product that was launched in 2018. Is this simply down to activist investor Saba Capital, or is it something else?
No, look, Saba has been the trigger for this, but that's because what they're saying is something we agree with. They're right, which is to say we launched this as an investment trust. It invests in small and mid-cap companies, so that you might think is a good structure for something that invests like that. But the problem is it hasn't worked. And there's a great quote from Richard Feynman, the guy who was a physicist who won the Nobel Prize, worked on the Manhattan Project, and he said, doesn't matter how smart you are or how elegant your theory is, if it doesn't work in experiment, you're wrong. And so, yeah, it's a structure that we liked for this, and we devised using an investment trust for this, but it hasn't worked in the sense that it's been trading at a persistent discount. And when you've bought back 40% of the trust, which we have been doing buybacks, and it hasn't eradicated the discount, you need to do something different, don't you, really? Otherwise, you get onto another quote from another great physicist, which is Albert Einstein saying, to repeat the same action, expect a different outcome is a definition of insanity. So keeping on buying back shares wasn't working. So we've proposed switching to an OIC, to an open-ended company, because then there can't be a discount. It will trade at NAV, basically, and everyone at any time will be able to get in or out at NAV.
Are there downsides to being an open-ended fund, i.e., if you go through a market downturn, you get redemptions from investors. They want to take their money out. The fund manager at Smithson will have to be forced to sell holdings. Where actually on an investment trust structure, there's benefits for permanent capital.
Yeah, look, you're absolutely right, of course, about that. As it happens, I mean, the average company, the median company that we've got in the fund has got a market capitalisation of 8 billion, and the fund, as we speak right now, is under 2 billion. So there isn't any liquidity problem. If we thought there was a liquidity problem, we would not propose going to an OIC, because experimenting with liquidity of these things is playing with fire, isn't it? So we're confident we could do it. What the industry probably should gravitate to, but won't, is having open-ended funds, so you can guarantee anyone could trade at NAV at any time, but with different dealing period. So instead of having daily dealing for everything which we've got now, having a dealing period which somewhat matches the underlying asset base. I mean, having a real estate open-ended fund with daily dealing is clearly nuts, as people have managed to demonstrate over time by having to gate their funds. We should really shift to having different dealing periods, but there's no sign of the industry doing that. I mean, if we were to switch to a different dealing period, we wouldn't be able to get onto a single platform in the UK, as you know.
Has there been any suggestion that actually it's just down to you're picking the wrong stocks? Not you personally, but obviously the manager for Smithson. Or is it, we could look at it that small caps are just out of favour in general?
I think if you look at it across the industry, not just in this fund, but there are other funds, they're out of favour across the industry. And also, when you look at the discount, which is really the discount to NAV, which is what's driven this proposed change, the discount to NAV is prevalent across all the strategies in the industry just about. I can't think of one that hasn't got that. No, I think for good or ill, the tide in the industry is very strongly in the other direction at the moment. If you think, what's the fastest growing product area in the industry? It's ETFs. ETFs are the diametric opposite of investment trusts. They're a clue in the name, exchange traded. You can trade intraday. You're not even limited to once a day. So that's where the trend clearly is. And so at the moment, I think the problem isn't our particular fund manager or even the fact that the strategy is out of favour. I think the fund manager, Simon, is incredibly capable. The strategy is definitely out of favour, but the whole industry's got the discount problem.
So if the whole industry has a problem, isn't it just a case of history suggests you be patient, you wait. Small caps will come back into fashion, and also you're not really small. You're more mid cap, really, than small cap, isn't it, with Smithson? So surely it feels like you're giving up now when actually. Are you giving up at the bottom of the sentiment so weak towards small caps? Surely you better wait.
Well, we're not giving up on the strategy at all. No. I mean, I would agree with you if we said we're closing down and going home now. We're folding up our tent and going. We're not. We're carrying on with the strategy. We're just changing the structure of the vehicle. And I think we're going for the structure of the vehicle because we can't see a way, notwithstanding whether the strategy is going to come back or not going to come back, to eradicate the discount. Plus, I mean, do bear in mind that we have got, if you think that we should be actually persisting with the investment trust structure in this, this, we'll put you in to explain to Mr. Bowes at Saba why that's a good idea, because he doesn't seem to think it is. And to be fair to him, he does have an investment in about 17% of the fund. So he's entitled to a view. And I don't think his view is wrong.
So with this, the restructuring means that anyone can sell at net asset value minus costs. Does that mean that Saba's that's their exit?
You'll have to ask them. I mean, they've said they'll support the vote for this. What they do next is entirely up to them. I mean, they'll let us know in due course. Probably because this is an act I would think they can repeat.
Is there not a risk that you actually get a big chunk of investors who go, okay, I've been suffering at a discount, I can now get out at NAV, and then you're left with a very, very small amount of assets under management? Is that
depends what you mean by a risk. I mean, obviously it's a risk to us as a business, but it's not a risk to investors, which is what we should be thinking about here, isn't it? I mean, in the end, what we should be thinking about, we've got a duty to actually think about the investors, and I think giving them the opportunity to trade at NAV, all of them, not just some in a tender offer, but all of them, giving them is the right thing to do. And if it ends up delivering what you've described, which is an exodus in a smaller fund, well, I'm afraid that's a consequence of doing the right thing. But we're not going to not do the right thing.
Well, Terry, thank you very much for talking about Smithson.